The Fed came in and delivered what the markets expected today. It is Wednesday, December the 10th, and this is Markets with Megan. If you like this podcast, you can subscribe, hit the alarm bell. Also, feel free to share this with friends, family, colleagues, anyone who wants to see what's going on in the markets, the economic data, what it means, and what they can expect to see going forward. Today, we're going to talk about the Federal Reserve meeting. This is the last one of the year, and it was widely expected that they would cut interest rates at this meeting. And they did. We did get 3 of the Fed voters that dissented. This is the most dissenting voters that the Fed has had since September of 2019. So a very divided Federal Reserve. The 3 dissenters were Moran, who wanted a 50 basis point cut, and then the Federal Reserve Bank president of Chicago and Kansas City both voted no for interest rate cut. They wanted to wait and see with the recent inflation data. Now, they also announced that they would be buying $40 billion of Treasury bills through the next 30 days, and that they might continue that over the next few months in order to keep that Fed funds rate in that target range of 350 to 375. There is a lot of year-end just disruption in the liquidity market, so this is something they want to get ahead of if there is any disruption there. In the comments, they noted that the consumer spending is solid, but housing remains weak. They did discuss how the labor market, the labor demand was clearly softening. And they did mention that the tariff effect would be short-lived and it's a one-time shift in prices. They also said that the recent rate cuts would stabilize the labor market and that inflation should continue its downward trajectory. As the past couple meetings, they said this is no preset course. They're still treating every meeting as a live meeting, and they may end up cutting interest rates again if the economy sours, or even possibly raising interest rates if inflation runs away. However, that's not any of the forecasts. We did get the forecasts, the economic projections, and what we saw there weren't a ton of changes except in the real GDP forecast. They actually upgraded GDP, and that's because they see a very resilient consumer. They downgraded inflation since their prior meeting, both at the headline and the core level, and that's for the next couple years. Really no change in the labor market data. They are expecting now just 1 rate cut in 2026 and 1 in 2027, and that's coming from their dot plots that they released. So that's a bit more hawkish than what they had anticipated in the last meeting. And again, the sense of this, the statement was that this was a hawkish cut to interest rates. Now let's break down just some of the things that were delivered in the question and answer session for the Fed. He did state that the members primarily think that where the Fed funds rate is now, that it's in neutral territory. This was a little bit surprising. They think they're well positioned to wait and see. So you can take that for what you want, but that sounds like they're not really in any rush to cut interest rates in the near term. There was a question about AI and the effect on the labor market. The Fed did note that they can see higher productivity. It can have a better impact on economic growth without the unemployment rate moving significantly higher. The dissenters and those differences that we talked about, that was primarily because of the fact that there's a difference in opinion on how balanced those risks are and which risks that they should focus on most. Remember, they have a dual mandate. That is price stability from the inflation standpoint and maximum employment. So there's some that are worried about inflation and some that are worried about the labor market. Where do you balance those risks? That's where those differing of opinions come from. They are also worried about the distortion in some of the economic data. They're going to have to look a little bit deeper into the data to get an idea of where they should go further with the interest rate policy, because the data wasn't collected during the government shutdown. So there could be some distortions not only in the labor market data but also in the CPI. Now, markets really liked this report. They did not necessarily look at this as too much of a hawkish report. They're shrugging off the fact that at one time they were expecting 3 interest rate cuts next year, and now the Fed's only saying there may be 1. There could be some optimism around the fact that the GDP forecasts were increased, that the Fed's not really worried about the labor market collapsing. And then on the back of this announcement, the yields are also lower. So when you have lower yields, that sometimes does increase the equity. So we're seeing that across the board, but it's more widespread than just the large cap growth technology story that we've seen. In fact, today you're seeing small and mid-cap stocks outperforming large-cap stocks, and value is outperforming growth. As we mentioned, yields are lower across the curve. Gold's actually lower because some of this flight to safety is being taken out of the market. And then the dollar is slightly lower on this news. That's all we have today. If you want a history of our podcast, you go to marketswithmegan.fm. Thank you.